The Commercial Real Estate Show is brought to you by Cohn Resnick, forward-thinking advice to navigate business and financial issues. Visit cohnresnick.com. By BB&T, banking, business, and commercial real estate loans. Visit bb&t.com. And Bull Realty, when your business requires proven performance, visit bullrealty.com. And by France Media, providing exposure to the world of commercial real estate. Visit francemediainc.com. Welcome to the Commercial Real Estate Show. Thank you for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead your company's success. And that's whatever type of company you work with. And laugh, I think we have to have some fun along the way. Well, hello, I'm Michael Bull, your host to the world of commercial real estate. Remember, if you have any questions or comments related to this show or any commercial real estate related endeavors, you're invited to get in touch with us by smoke signals or carrier pigeon if you like. Well, you can connect with us by Facebook, Google+, LinkedIn, or Twitter. You can find them all at commercialrealestateshow.com. There's also another incredible system that some young people are starting to use today. It's a system that when you communicate, you actually hear someone's tones and voice inflections, a system where you can immediately respond in real time. Get ready for this. Wait for it. It's the telephone. It's coming back. Call us at 888-612-SHOW. Operators are standing by. I'd love saying that one there. All right, well, today we're going to talk about the U.S. office market. You know, office property performance in the U.S. has been improving despite the effects of continued deficit spending, increased income taxes, years of corporate downsizing, and lackluster job growth. So what is the story? Is it time to buy office properties? And what should we expect moving forward? Well, first, please welcome Ryan Severino, senior economist with Reis. For more than 30 years, Reis has been a trusted provider of impartial commercial real estate performance information and analysis. Reis provides updated trends and forecasts of rent, vacancy, and inventory for apartment, office, retail, and industrial properties. And they do it in up to 200 metropolitan areas and more than 6,300 markets and segments. Ryan, welcome back to the Commercial Real Estate Show.
Thank you, Michael. Good to be back.
Well, Ryan, let's start with a look at the U.S. office market. You know, how did the sector overall perform in the first quarter?
About on par with what we've seen. National vacancy fell about 10 basis points during the first quarter. It's exactly the same pace as the 10 basis point decline that we observed in the prior quarter, and it's roughly the same pace as any occupancy vacancy improvement that we recorded throughout 2012. And so we're kind of on this slow but steady downward trajectory in vacancy right now. On the rent side, both asking and effective rents grew by about 0.7% during the first quarter, and it's a little bit of a slowdown relative to what we saw in the prior quarter. But that said, 0.7% is well above the quarterly average of about 0.4% that rents have been rising pretty consistently since the fourth quarter of 2010 when the market turned around. And so I would say we're heading in the right direction, and given the changes in those equilibrium variables, not surprisingly, we saw net absorption once again positive during the quarter, a little over 4 million square feet, and that is also about on par with what we've been experiencing in recent quarters. So we're more the tortoise than the hare here. We're kind of slow but steady.
I see. And is that what you expect to see with the economy where we are and in unemployment? And what do you expect? Do you expect these trends to move forward into 2013?
Yeah, I would say for the remainder of this year, that's about on par with what we should expect. I do expect to see continued improvement in the sector, but I don't really expect to see any acceleration in that rate of improvement. So I would expect vacancies to compress another 20 or 30 points for the remainder of the year. I'd expect to see net absorption remain positive, totaling somewhere in the neighborhood of maybe 30 million or so square feet for the year. And I think for the year we're talking about asking effective rent growth of about 2.5% to 3% respectively. So, again, not an acceleration, but I think consistent improvement is pretty welcome given all the headwinds that the economy faces that you had just mentioned.
Okay. Well, we're talking with Ryan Severino, economist with Reis. And Ryan, what are the factors that you see affecting the office property performance moving forward?
Clearly the ongoing weakness in the labor market is of paramount importance for the sector. And it isn't just the fact that we aren't creating enough jobs right now, but the composition of the jobs that are being created is not very good because many of them are just not office-using jobs. And this is obviously what is really required to move the needle for office demands. I would say most of the compression in the unemployment rate that we've seen so far has come from segments of the labor force with the lowest levels of educational attainment, and they just aren't the types of folks who are going in working in office buildings. I think the other major question out there is whether or not small to medium-sized firms continue to increase hiring. There's been a bit of a resurgence in their hiring last year, and the trend over the last few years is certainly positive, but we still have a long way to go on that front. We can't just have the large firms doing all of the hiring and expect the office market to recover in any kind of pervasive fashion.
Okay. And with this slow growth and improvement in the market, how is that affecting investment sales? Has sales volume improved and cap rates continue to compress? What do you see so far?
We've seen a pretty decent rebound in office transactions. Single property sales volume tripled between 2009 and 2012. We're still finalizing our first quarter data, but I'd say right now we're running about on par with what we saw, maybe a little bit slightly behind 2012 volume. So I think what's going to be really interesting to see is how rising taxes and sequestration really end up impacting the economy and the appetite for office investments. I'd say cap rates ended the year somewhere in the mid-7 range. That's about flat relative to where we saw cap rates the year before, the last couple of years. There's definitely been a bit of a slowing in cap rate compression during the last 12 months or so.
And is some of that from the volume of sales moving to less higher-end properties, maybe some larger investors interested in B product, if you will, or non-gateway cities? Is that affecting your overall cap rates?
Yeah, I would say there's been a little bit of pricing fatigue on the part of investors in sort of the primary gateway markets just because pricing had gotten so rich. And so while it's not, I certainly don't want to make it sound like it's any kind of paradigm shift. There has been some averting of eyes away from the primary markets toward some of the secondary and to a lesser extent the tertiary markets. I think some of it is the fact that, performance and fundamentals in the office sector just haven't been tremendously conducive outside of very high-quality assets in primary markets to entice a lot of people back in. And so with people easing off the gas pedal in the primary markets, there's just been a little bit of a stagnation in cap rate compression right now.
Okay. And Ryan, what about performance variances between markets? Are there certain classes of properties or areas seeing more demand?
I would say there's kind of a huge rift between the winners and the losers in the office sector right now, and it largely breaks along geographical lines. I would say that metro areas that are tethered to either the technology or energy sectors of the economy have been the clear outperformers because those are the sectors of the economy that have performed really well during this recovery. And I would say even within that, it has really been the CBD areas of metros, those key central business districts, that have been outperforming their suburban brethren because hiring has been primarily driven by these large firms, at least up until recently, which tend to locate in the CBD areas. So it's a clear differentiation in terms of the composition of the metro-level economy and then which submarket the buildings tend to be located in.
Yeah, that's interesting. We represent tenants in Atlanta, and in some of the markets, it's really tight, and you can't get that great a deal. And some markets is wide open. You can name your deal. Well, do you see any trends or surprises in the office market numbers, Ryan?
I would say that this remains a very, very concentrated recovery. And I think once you get away from a relatively small number of markets, there's really little job growth and little net absorption to support a turnaround. And we're just not experiencing a pervasive enough recovery in the economy and the labor market right now for that to really change. I would say, it's going to take some time for the have-nots, if you will, to even attempt to catch up with the haves in the office market. So I think for the time being, we should expect this concentrated recovery to persist probably until 2014 when the economy probably, gets past sequestration, stomachs, the rising taxes of 2013, and you probably see a more widespread recovery in the economy and the labor market.
Okay, we're short on the break, but where do you see opportunities?
Yeah, I would say pricing has gotten expensive in markets where fundamentals have performed well, and I think it's getting difficult to find good opportunities there. I'd say because the office market isn't like the apartment market where the recovery in fundamentals is so pervasive. I'd say there are opportunities to be had once you get away from those the key primary markets and the key CBD areas. I think if you start to look at deals outside of those CBD areas, I'd start with those markets that have been outperforming the energy and technology markets. But I think as you're starting to see small business hiring come back, those suburban markets will eventually recover. And I think while it's difficult to be a little bit of a contrarian and be a little bit early to the game, I would say it's only a matter of time. It's a very cyclical industry. Those suburban submarkets will start to come back, and when they do, I think there's some pretty attractive opportunities out there for those of us who are willing to be a little bit more ambitious and take a flyer on deals like that.
Well, Ryan, thanks for joining us today, and stay with us. We have more office market intel headed your way. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is made available by professionals at Cone Resnick, BB&T, France Media, and Bull Realty. For more information about these companies or to access additional show podcasts or videos, visit commercialrealestateshow.com.